Hi guys, welcome to another week. We are all audio this week, but we will do the same structure. I'll talk you guys through the economic data of the week, and Andrea has a lot to offer in terms of going through this week's equities. So this week we're kind of splitting the economic data into two sections, the week gone by and also the week ahead. Two really important weeks in terms of the data that's being released and the data that's about to be released. Monday in Germany was a bit of a focus. Producer prices at 25.9% up year on year. That's a huge amount, and it makes a bit of a mockery of the recent positivity surrounding the DAX. Tuesday we had the UK public sector borrowing data. That was up, again ahead of estimates, although it's a bit too early to read anything into that, but that's something certainly worth keeping an eye on in coming months. Wednesday was a big day of data. CPI ahead of estimates at 6.2%. RPI month on month up again, pushing year on year numbers to 8.2%. Producer prices year on year again ahead of estimates at 14.7%. And on the whole, putting all that data together, you begin to see how it just keeps pushing the inflationary narrative. And again, on the back of that, makes a bit of a mockery of the current levels where the UK's flagship index currently is. Over in the States, the US 30-year mortgage rate was in focus. That numbers this week came in at 4.5%, up again on previous week, but up 1.8% in the last 18 months alone. That number will start impacting kind of purchasing behaviour within the United States. It will start impacting household savings, and obviously on the back of that, eventually it starts hitting company profit. Next week is a really big week for data, especially out of the UK and US. Bank of England speak on Monday. That certainly needs keeping an eye on. We'll probably get a lot of clues about where interest rates are going and certainly the tone of the next meeting. Tuesday we have data releases in consumer credit. We expect that number for February to be around about 0.88 billion. This really is worth knowing. Obviously consumer credit is really important for economic growth, but it's showing signs of that it's not economic growth. In fact, it's just individuals borrowing to try and sustain a lifestyle. That is obviously very different, and that would be a real negative. Again, the following day, Wednesday coming, we have mortgage approvals. We expect that number for February to creep just above 74,000. That would kind of progress the narrative of we're still very strong on financials and your lending banks. Seeing that number at 74,000 would confirm that. Thursday this week coming, Q4 GDP data. We expect that to come in at 6.5%, but that number would actually disappoint markets. Putting that all together, we do see a negative week for the UK's flagship index. Huge week ahead over in the US, consumer confidence, ADP numbers and Q4 GDP. Q4 GDP isn't as an important release as you would imagine. Consumer confidence and the ADP numbers will be the ones to watch. Thursday we also have personal spending and inflation data, before Friday non-farm payrolls. I think we're just going to run you through some of our forecasts that we have on that, so we can kind of build a picture as to where we kind of see US indexes going over the course of the week. So our forecasts, we have the ADP numbers at 425,000. Again, that would be expected to disappoint markets. GDP would come in around, will come in at 7%. This could come in lower if inventories have depleted. The last GDP data release was flattered in terms of inventories. Jobless claims we expect to be up to 200,000, again disappointing the markets. And then the next two numbers kind of go hand in hand. We expect personal income to show up by 0.5%, but consumption down by 0.5%. So they go hand in hand. You would expect, as personal income is up, people to be spending more, and that shows a positivity within an economy. But in this case, personal income will be up, but consumption will certainly come in at below 0.5%, and that would just indicate signs of a little bit of weaknesses going ahead. And then the big one on Friday, non-farm payrolls will certainly come in less than 500,000. That'll be a big drop from previous month's February data at 683,000. There's also an indication in the hours worked data, again on Friday, that number will be up. So again, America's labour patterns just beginning to show slight changes. Hours worked up being a key one. That's been something that's been down for quite a few consecutive months now.
Hi guys, we're going to cover things in two parts this week. We're going to review some of our charity account portfolio holds, then a few requests from throughout the week. So let's begin with stocks that are nearing exit. Week 19, Amitech bought at 129, currently at 133.5 as we look to 139. Week 17, Akamai bought at 111, currently at 117 with exit at 124. BT was bought at 173, currently at 185, and we're happy to hold for a considerable period yet. Repsol is closer to exit, bought in week 6 at 10.95, currently at 12.16 with exit now only 50 cents away. Suncoke is currently moving in the right direction, bought week 2 at 7.65. It's currently at 9.2 as we look to an exit beyond $10. Virgin Money was added as trade number 20 in October by just above 200p. The price has come back to 178p, but we remain strong, especially through a rising rate environment. 2022 will see revenues up 13% year on year to 1.69 billion, with operating income slightly below 800 million. Some major banks have recently gone underweight, but we expect nothing but positivity from next year update and continue to hold up to 235p. The watered down ring fencing rules will act as a catalyst in coming weeks. Now, Ashford Hospitality was bought week 15 with price since retreating back below $10. The hotel REIT has been subject to increases in short interest for some time. Currently $19.9 million, which represent 6.4% of float. 2022 will see full year revenues back at 1.17 billion, with EPS returning positive for the first time since 2019. This was more a speculative play, which hasn't worked out. We will exit at $14 for a moderate loss. However, that $14 represents 40% upside from current price. BASF, the chemicals giant, was bought in week 9. Asset price remained static before falling from 68 to 48 euros in February. The company is facing price pressures on rising costs for raw materials. Currently at 52 euros, the stock is a standout buy right now with its 6.3 dividend yield and consistent growth. The balance sheet remains strong even with margin squeezing. 79 billion of revenue forecasted and net income still beyond 5 billion, even with net margin reduced to 6.5%. They've got great dividend and asset price will creep beyond 70 euros. That makes the pullback a buying opportunity. Hyster-Yale has been in decline since buying in week 8 with current asset price at $35, but has found support at that level. There's enough institutional support to indicate the stock is at a bottom, making it a good buy right now. Profitability won't return until 2023, but the company carries serviceable debt and a healthy 3.7 dividend. Losses will be halved during 2022, with 10% year-on-year revenue growth, which should get the stock moving northwards finally. A few requests to cover this week. We've selected Shopify, Twilio, Snowflakes, and Store Capital. Right, first off, Shopify, the cloud-based commerce platform, has been under sustained pressure, and this will be set to continue with current exposure to the market at 1.75. So don't be fooled with the positivity of the last couple of weeks. The 52-week low at 510 represented value, and for those who missed it, you can expect to see the price again. Year-on-year revenue growth is stalling, but in dollar terms, it's very healthy. Certainly enough to justify market cap at the 60 billion level. 2022 will see net incomes pull back before positivity on all metrics in 2023. Twilio currently trades at $155 from 52-week highs at over $400. There's been a flurry of price upgrades to around the $300 level, with ARK pricing up a considerable stake last week. It's easy to see why, although we are nearer to $205, as we try to avoid anything pre-profit and consider the comps to great. They will remain pre-profit in 2022, although losses reduced to minus 88 million. It's a vast step forward. 2023 will see EPS positive at 0.22 and should justify $250 as an underlying price. Right, Snowflake. Snowflake is a company we like and sold out within $2 of a high as it became value trapped. The sheer rate of institutional selling is what forced price as low as $180. Sell-offs were up 29% over the last 6 months, with the number of sellers increasing to 288, with fund managers most active. The balance sheet isn't bad. It's just bad for a company valued at $70 billion. They definitely will see profitability in 2023, but only marginally at $44 million. That's good enough for EPS at 0.11. Capital expenditures are on the rise, and we're in no hurry to re-enter the stock. Finally, Store Capital is a victim of the wider issues within REITs. They do carry limited market exposure, but unless they are considerably undervalued, it's tough to see much upside. 52-week numbers of 28 and 37 is what you would expect, and it carries a solid dividend at 5.3%. Current price to fund from operations at 15.5 against estimated forward at 13.92. That means you can expect to see the stock slip out of its 52-week range, providing a buying opportunity nearer to $26.
Well, that's it again for another week. Thanks for listening rather than watching on this occasion. I'm sure we'll be back with the audio next week. This week, it's just been a case of us being in two different places at the same time. As you can see, we've once again covered quite a few of the requests. Keep them coming, and we will certainly try our best to cover them. Thanks very much.